Hello and welcome everyone. Thanks a lot for joining us on this Sunday in this special live stream where we are going to talk to you about a very interesting question that we keep on getting from our investors, right? So broader markets have picked up in the last 1 month. We saw a lot of volatility in February and March. And now I think a lot of questions that we get, are actually very, very diverse. Some people are asking, should I stop? Should I sort of take a pause before elections? While others are asking, is it the right time to top up the investments, right? So in today's live stream, I'm going to talk to you about what is the right time to top up your investments and, what does the current market scenario tell us? And the third point that I'm going to talk to you about is, you know, uh, large caps and our new portfolio that is out right now, right? So without much ado, I'll just move on to the presentation. Please do post your questions in the chat and we'll take them up as it goes. Awesome. So like I said, a lot of questions that is it the time to top up the investments, right? And actually, what is the correct time to top up the investments, right? That's the question. So to answer that, we did some analysis, like, at Wright Research, we do everything with a data-driven fashion, right? We take all our decisions based on data. So that's what we did. We tried to do an exercise to understand when is it actually the right time to invest into the market, right? So that is what we will sort of start with. So the first question, first thing to note is that the time in the market is much more important than timing the market, right? So, even as an investor, you would have seen that if so many people I talk to would tell me that, okay, I stopped investing right after the COVID crash. I stopped investing in 2022 when I saw volatility, right? People stop investing whenever they see some correction, and what they end up doing is they miss out the best days in the market. If you miss out the best days in the market, you would see that your returns would dwindle quite a lot. So here I have stats from the Nifty. If you see that the Nifty CAGR since 2014 has been around 13-14%, right? But if you just missed out the 5 best days in the market, your CAGR goes less than 10%. If you missed out the top 10 days in the market, your CAGR goes down further. And, let's say you missed out the top 50 best days, your CAGR in fact becomes negative. So what this tells us is that being in the market is much more important than trying to time the market, right? Usually the best days come after some correction. And, if you are missing out or exiting after a correction, you would be missing out the best time in the market. Now, so that sort of emphasizes the importance of trying to be in the market and being invested. If you are investing into the strategies offered by us, you should have a longer term vision, right? So what I would really discourage people to do is make very short term goals with our strategies, right? If you're seeing, a 70%, 80% return come out in a short span of time, that is not the time to top up, because markets can be volatile in the short term. But if you have a longer term goal, if you're planning for a longer term goal with our strategies, there is no better time to invest than now with these strategies, right? Now, so the analysis we did was that Nifty has a CAGR of around 13% since 2014, like I said. But what happens if we try to time the market, right? So first thing we did was we tried out the XIRR returns, which is the return on actual capital invested, if you did a SIP versus just invested in the Nifty. So you would see that your returns get a little bit better if you're doing a monthly SIP. Your XIRR returns are slightly better, not a lot, if you're doing a monthly SIP. And you would see that, you would end up, investing 120 times you're doing an SIP. But what if, you invested into the Nifty after every 5% correction? So the day the market corrects 5%, you top up your investment, right? So we did that exercise and we found out that the XIRR in fact increases a little bit when you're doing that, right? So but it's not significant, right? It's not like a major enhancement, but still you see a slight increase in CAGR. What you would see is the number of times you invest becomes lower, right? You would be investing only 50 odd times in comparison to an SIP where you're investing 120 times, right? Now, what if we invested every time the market corrected 10%, right? So again, if you look at that data, you would see that, okay, my CAG, my XIRR has definitely increased, right? It's gone beyond 15%, but, I don't have those many instances to trade. I would hardly have less than 10 instances when I could top up my investments if I'm waiting for a 10% correction. So while, that might be a better strategy, but it would end up giving you a lesser chance to sort of top up. Now, we also tried what happens if you invest every time the market corrects 15%. If you did that, you would see, okay, my CAGR definitely has increased a lot, but I don't get any chance to top up, right? I would hardly get one or two chances to top up my investments, right? So the black line here shows the chances to top up. Another thing that people do is sort of go with the flow, and when they see a 5% revival from the index, they top up, right? So if you did that, you would see your XIR returns are slightly better than just investing into the Nifty. You get fair amount of chances to top up, but it's not a significant sort of uh, you know uh, enhancement. If I topped up when I saw a 10% rise in the market, I would see my XIR has increased again, but I only get around 20 chances to top up. If I topped up when my returns were 15%, you would see my XIR definitely has increased quite a lot, but I'm getting very few chances to top up. So topping up investments based on any correction is a tricky thing, Definitely, I think topping up at a 10% correction, or let's say a 15% correction, makes a lot of sense, but you get very few such chances to do that, right? So what this tells us is that being invested is a much more important thing than trying to sort of time the market in that sense. It gets very tricky when you're trying to time this. We also did this analysis on the mid-cap index. You will see mid-cap index definitely has a better return in comparison to the Nifty XIRR, but you would see that similarly, if you topped up at a 10% correction or 15% correction, you get a better return for sure, but your number of trades definitely go down much lower, right? And similarly, if you topped up at any 5%, 10%, or 15% rally, same numbers will replicate for the small cap index also. In the small cap index, you definitely get more chances of 15% correction. So number of trades, if you're doing that 15%, 10%, you would see you're getting much more instances. But the impact on the XIRR is not that significant. In fact, what makes sense here is to top up when you have a 15% XIRR, rise in the small cap index, and then you're topping up, but you get very small number of trades. Again, see, these data points that I'm showing you here, what you would note is that these are for the last 10 years. Last 10 years, if we try to understand, have been, increasingly bullish, right? We've seen this excellent market 2020, 21, 23, even in 2014, 2017, there has been some very exciting bull market. So these numbers, are based on that maths, right? Based on the maths of some strong bull markets with some mixture of sideways and some corrections there, right? And the situation, in fact, changes depending on the market outlook, right? So while this is a basic mathematical calculation on what happened if you topped up with some correction or with some rise, a better idea, in fact, would be to understand the market and based on your outlook, take that call, right? So typically what you would see, if you understand the macroeconomics, that whenever there is a cut in interest rates that leads to inflow into equities, wherever, there is a rise in GDP growth rate that leads to, a resurgence into the equity market. So that gives you a better sort of sense to try to time the market instead of waiting for any correction or any upsurge, right? So therefore we will now try to do an analysis of the market. Before we do that, let me quickly take you through the performance of our small cases. you would see that, okay, we've seen a tough 2 months in February and March, right? Some of our strategies like Alpha Prime and others have seen correction, and there has been a lot of discontent in that sense. Therefore, I said that whenever you are investing into that strategy, take this as a note from me, that don't invest for the short term with our strategies, right? These are not short term strategies. When we say there is a risk associated with all of these strategies, that is what happens in times of corrections. You see some sort of correction happen. But the best part is that if you stayed invested with a longer term, you would see the recovery take over, right? You would see that the portfolio resurges and gives you the better long-term return. So that's what we're seeing, at least in April. Some of our strategies like the Right Small Caps and the Right New India have in fact had a very good resurgence. We've seen that, okay, large caps have been slow, mid caps have done better, but small caps have seen the best sort of a resurgence in the last month. And therefore, some of our strategies like the small caps, like the New India, have seen the best sort of recovery. But having said that, other strategy like momentum, balanced, alpha prime, innovation have also done quite strongly, right? And the current mix of stocks in all of our portfolios, you would see, is a mixture of large, mid, and small cap. There is a little bit of bias towards large and mid caps, given the volatility, and that has organically come from our models. And we are sort of accounting for that as we take our decisions in the next few months, right? So having said that, let's talk about the market overview and what is the market telling us if we want to take a decision on should we top up right now or not, right? So what are the big concerns that people have right now? I think the number one concern that people, or the biggest question that we keep on getting is elections are coming, what's going to happen, right? Will there be volatility before the election? Will there be a rally after the election, or will there be a correction after the election, right? There's a lot of noise around that in the market, and I think that is one big event that people are talking about. In fact, on our YouTube channel this week, we've done a video on the elections and our outlook. Siddharth Baisura and Siddharth Agarwal have posted a very good video on that. There's also another big event that is coming, which is the global elections. US is going into an election, UK is going into elections. Some of the major economies around the world are going to elections, and elections are an important thing. I don't see, I have a chart for you about the elections in this presentation. And what you typically see is election is like a big event, right? It's like a rate cut event, or it's like a big earning. You see, I don't know, like right now it doesn't happen, but back in the day when Infosys would release the earnings, there would be a massive up and down move in the market, right? Similarly, election is like a big event. It causes uh, reactions, right? But what I really believe is doesn't fundamentally change the direction of the markets. The markets in by itself have the inward trend, which are not influenced a lot by the political scenario, right? So we are not very, very worried about the elections, but there will be shorter term moves around it. Another big event that is coming is the rate cut. Rate cut is expected to come out in the US, but it's getting delayed every month. Last week, we saw results around, US growth come out, which were lower than expected. We saw some type of, a rise in inflation being hinted with those numbers, and that would concern the global scenario. It could bring down rate cut faster if the growth is impacted, but if the inflation does not go down, then that could delay the rate cuts also. So that's another big thing that people are looking at. And also, I think another thing that people talk a lot about is the rise in commodity prices. Metal prices are resurging. China is buying a lot of metals. Is it a resurgence of a commodity rally, or is it a short-term impact in the market? That is something to be seen. So we'll be covering some of these topics bit by bit in this presentation, and which will give us a sense if what should be our outlook about the market. Are we optimistic, or is it not the time to top up, right? So the first thing definitely is the strength of the Indian economy, right? So if you look at the numbers, you would see that people, global rating agencies, people across India, banks are all re-rating the growth in India to be the highest among various countries in the world and actually revising it upwards, right? So the IMF, World Bank, Citibank, Fitch, everybody has sort of re-rated the expectations of growth from the country. And if the growth expectations are revised upwards, that leads to, a growth in the stock market also. The growth, totally comes and translates into the rise in the stock market. So that is a very strong cue. And I think that is one big thing to be positive about. And obviously, there are various forces at play which are causing these resurges. Number one, obviously, India is a huge consumer nation. There is a rise in consumer demand, and that will continue to be robust no matter what. That sort of is fueling the growth of the Indian economy. The government initiatives, especially in the infrastructure segment, in the green energy segment, and manufacturing segment, are boosting the growth in the economy fundamentally. And then you have foreign investors also looking at India as a very bright spot of growth, right? So a mix of these things is leading to a revision of the growth outlook in India. And I think that is one fundamental thing that makes us extremely positive about the outlook from our economy, right? And the stock markets. Now, the next thing, like I said, we'll discuss about elections, right? So elections are a very tricky thing, right? If you ask me what's going to happen after in June, or how the market is going to move around the elections, I would not be able to give you an answer, right? But if we sort of analyze the data from the past elections, what you would see is that the elections typically tend to be a positive event for the stock market. There has, if you look at the average returns, 6 months, 3 months, during that short span of time when the elections happens, after 3 months, 6 months, or 1 year, you would see the average return from the markets tend to be positive around elections, right? We're seeing some resurgence happen in the run-up to the elections even right now, but broadly, elections tend to be positive based on historical data. What you will also note here very interestingly is that any shift in government policies or continuation of government policies do not have like a correct answer here, right? So if you saw, there was a 2004, there was a change in policies, and the market reacted negatively and then picked up, right? Then 2014, there was a change, but the market continued to be very, very strong. Similarly, a continuation of policies also does not give us a clear answer. 2019, there was a continuation, but there was a correction in the short term. 2009, there was a continuation, but it was rewarded by a lot of, strong trend. So election by themselves definitely do influence the market, but there are broader things at play which will provide direction to the market, like we saw about the GDP growth rate. Now, having said that, let's look at the near future, which is the big event in terms of earnings, right? In terms of earnings, this quarter, people have been expecting the earnings to be slightly muted, right? And why is that? Because of the global interest rate scenarios, currency exchange rates, and the inflation. People were expecting this quarter to be seasonally low, right? This quarter to not be as attractive as the last quarter, but that does not impact the price returns, right? See, expectations are already built in, right? And what impacts the market is actually how do the earnings behave as per expectations. Are we beating expectations, or are we not beating those expectations? What we have seen is a very good mixed bag in terms of earnings, right? In terms of IT sector, you would have seen that the IT sector ended up being, TCS came up with slightly positive outlook, right? They did as per expectations. They had very good deal flow coming in, and people took it positively. Infosys similarly, did not have a lot of attractive things, but obviously the deal flow looks strong, which talks about resurgence of the IT sector somewhere in the future. Similarly, if you look at the banking segment, you would see that obviously ICICI Bank, which posted earnings on Friday, had an exceptional earning and people are really excited about it. Similarly, Axis Bank posted, very attractive earnings and saw that reaction in terms of prices. But, we also saw Bajaj Finance, which cut down its growth outlook, which saw some slowdown in profit growth, and it saw some impact in terms of the price movement also. Even other sectors, if you look at it, we've seen decent earnings being posted by Nestle. HUL has missed out by a bit. There is a slowdown in rural demand that hasn't picked up. So there's not a lot of excitement in the FMCG segment. In terms of metals, we saw, even though Vedanta posted a loss, uh, a huge amount of rally happening in that segment because they did not beat did not, sort of disappoint. They were as per expectations, and the outlook continues to remain strong for them. So it's been a mixed bag. There is no major disappointment as such. People were expecting growth to be moderate, and that's what we have seen. And I think all in all, it's looking like a good earning season as a whole, right? Now let's talk about another huge thing that impacts the market, which is the interest rates, right? So whenever the rates are cut in the US, that would give confidence for the Indian RBI to cut rates. When the rates are cut in our economy, that would lead to credit being available much more easily. There would be more lending. There would be better growth across the economy, right? It would be easier to borrow money. So therefore, people are waiting as a rate cut as a big cue that could provide a direction to the market. But unfortunately, that doesn't seem to be happen anytime soon. So, if you follow the US rate policies, which I do very actively, you would see that, back in January, people were expecting rates to be cut as soon as March. Then that expectation moved to May, then it moved to June. Now, if you look at this chart, you would see the expectations of a rate cut in May, June, July are in fact not there. Right? People mostly expect the rates to be stable till, or to be stagnant till July. Only in September there is a slight chance of a rate cut, right? So if you look at differential between the probability, so these numbers show the probability of a rate cut or the rate in different zones. You would see there is a slight possibility of a rate cut in September, but the US data that came out hasn't given a lot of confidence to the market. So in fact, it is a low chance of a rate cut. Still, people are expecting some rate cut definitely to happen in this year, in this calendar year. But I think that is something to wait and see. And see, what I always tell people is that rate cuts definitely will bring a lot of boost to the economy. That is what the economics say. But typically, what you see is that wherever there's a rate cut that happens after a lot of delay, it actually causes sometimes a negative impact into the market also. Now, why does that happen? See, the negative impact that you might see from the market, it happens because the rate cut came very late, right? So the US Fed was trying to slow down the growth in the economy, but they ended up overdoing it, right? They in fact made the growth slow down quite a lot. That pushes the economy towards some sort of a recessionary environment. So that could be one worry that you should have in the longer term. But I think things are moving quite organically, and the Fed is watching the data, and we could expect some rate cuts happening, and I hopefully they don't come in too late, right? Now, having talked about that, let's talk about another big concern that people had in terms of valuation. People were worried about valuations in the market, in the small cap index, in the mid cap index, and we've seen those valuations definitely correct a little bit. Um, and I don't see a big concern in terms of valuation right now. Uh, so if you overall sort of look at our outlook, we are careful on valuation. So we don't want to go to extremely highly priced stocks right now. We are seeing a little bit of bias happening towards large cap or slightly quality stocks in comparison to small and mid caps. we are cautiously optimistic, right? So if you were to ask me for my outlook for the next 1 year, we are optimistic. Obviously, we see certain risks. So we are cautious. We know that we have to be very strong with the risk management in the next year, but we definitely are quite optimistic. In terms of where do we see allocations go, I think financials, defensives are getting good sort of performance. Along with it, if you look at it right now, you're seeing the infrastructure, you're seeing some of the PSU segment also pick up. So we are, watching the data and we'll allocate as per the numbers. And like I said, we are prepared for the volatility. We are keeping an eye out for that. And, we continue to be cautiously optimistic, and we sort of encourage people to, definitely do allocate right now. If you look at the current market scenario, there are a lot of, things happening, but there is definitely an optimism that is there for the next year. Now, having talked about that, let's quickly talk about the large cap versus mid cap versus small cap. So you guys are all aware that we launched a new portfolio in the last month. That was Wright Titan, right? And Wright Titan was launched at the peak of that volatility that happened in January, February, March. And the idea is that large caps can end up being a cushion to your slightly higher risk allocations, right? So let's look at it from different scenarios. If you are, let's say, slightly more mature investor, right? And you're looking at more capital preservation, then obviously large caps are a way to go. And even if you are a high risk investor, a young investor, definitely you should have a high allocation to high risk strategies. But allocation to large cap diversifies away your exposure, cushions you in terms of volatility, gives you a much more balanced returns, right? So an exciting portfolio we've launched for all investors where you can come and allocate. To give you an analysis of large caps here, I have a few charts again where you would see that there are scenarios where when there is volatility, and in those scenarios, large caps sort of shine, right, over and above mid and small caps. So on your screens, you will see the charts for 2018-19 when there was volatility in small and mid caps because SEBI came up with a rule. Uh, uh, and large caps did not get impacted as much as the small and mid caps. Similarly, look at 2008, you would see when there was this large correction that happened in the market, small caps corrected significantly, but large caps did not, actually did almost 20% better than small and mid caps during times of high volatility, right? So what that tells us is that as we prepare for any sort of volatility coming to the future, we should have a slightly higher allocation to large and mid caps. We should, if not a large allocation, then we should definitely have some allocation to these stocks in our portfolios. And therefore, we launched our Wright Titan small case. So if you go to our small case portfolios, you would see that our Wright Titan strategy has been launched. Especially for this live stream, we have a coupon code LARGE25 with which you'll get a 25% off. And exciting portfolio for you to get exposure to large caps. Now, it's not just picking large caps. We are using certain factors definitely to pick these stocks. So we have a mix of some, some high quality, some risk metrics, and obviously momentum to pick up stocks from the large cap universe. You would see only stocks with a market cap of 20,000 crores and more to come up in this portfolio. And it's a mix of it. We're not just picking nifty stocks. It's a very good mix of stocks right now. And you would see in this 1 month that the strategy has been live, it has done better than your Nifty index or the large cap index, right? So it's a good portfolio to look at large cap exposure. And, while definitely, if you ask me personally, I would love to invest into a momentum strategy. I would love to invest into a high growth strategy. But adding a mix of Titan to this would only stabilize your portfolio, reduce a little bit of your headache. And so it's a great portfolio for you to add if you are looking to, sort of diversify away your allocation. So with that, I've talked a lot. I think I've given you a brief overview on trying to time the market, how to look at the current outlook, and about a new portfolio. Let's now jump up and take some questions from the audience, right?
Great. So Sonam, we have a few questions from the form that we floated. I will just start with that.
Yeah, yeah.
In the scheme of things that we've sort of discussed, the first question is from Chetak,
Mhm.
which is, should I wait for a market crash to invest?
See, like I said, ki if I could tell you ki there's a 15% correction happening and you should actually invest when that happens. But I cannot do that for you.
Yeah,
Right?
honestly.
Nobody can sort of tell you when the correction happens. If I could tell you, then I don't need to be here, right? But definitely, I think more than trying to time the market, being in the market makes much more sense. Look at, again, reiterating it again and again, right? That always have a longer term outlook when you are looking at our strategies, right? It's not a short term strategy, right? So don't look at a 70% return from alpha and try to make all your money in the next month. It doesn't work that way. It's not a bond strategy. It moves with the market. And but yes, if you are looking to allocate for 2 3 years, that is when it is a good strategy, and that is what the outlook should be, right?
Sure. Just to follow up on the sort of overall topic of today's discussion, Kunal Shah has sort of just made a brief observation and a statement. He's saying that the analysis that we've done on the best days in the market, we should also maybe consider missing the worst days, right? And that could maybe have a higher impact in terms of obviously the
Yeah,
compounding effect.
yeah.
And obviously adding both of that would maybe give a more reasonable outlook. That's the statement.
Yeah, yeah. I think that's a fair point.
Another question that we have here from one of the investors is on rebalancing, and I will try to sort of bucket it with other questions. It's a question from Shiva where he's asking, he had there was a rebalance update that he had missed out on. And then I think this is for the Alpha Prime portfolio and the balance portfolio specifically. So one is a weekly rebalance, one is a monthly rebalance, and in that, for one of them, he had missed the rebalance, and he rebalanced it about 5 days later. At
Right.
which point, some of the stocks had obviously the price points had changed. So he's asking if he should be executing the rebalance on the fifth day on a specific sort of thesis, because he's sometimes I think the stocks have gone to upper circuit or lower circuit, right?
Right.
So in those scenarios, what should be the strategy that some of these investors should follow?
Right. I think that's again a very good point. See, Alpha Prime is rebalanced on a weekly basis, right? So if you have missed the rebalance for 5 days, better do it on the next Monday, right? Uh, on our other portfolios, we rebalance on a monthly basis, so you can rebalance on a fifth day. See, realistically, to be honest, rebalance, the strategy that we are showing, if you want to follow along, you should be following along with the rebalance. But realistically, if you miss the rebalance by a few hours to a few days, in a broader scheme of things, doesn't really destroy your portfolio, right? I've seen some of people whose portfolios I look at, right, who haven't rebalanced for a few months and still their portfolios have stood strong. So it's not like the word ends if you don't rebalance on the same day. But if you want to stick close to the strategy, I think that is what we are suggesting, right? Rebalance when we suggest. But yeah, see, it's a portfolio sort of managed by you. We are advising you, so you can actually customize it. You can go manage that portfolio, add and remove stocks. You could, in fact, edit the rebalance also. So it's totally up to you. What we suggest is that definitely go along with the rebalance, right?
Sure. And just to, so I think he's also asked a similar question on the same lines, was that if a stock has hit upper circuit or a lower circuit
Hmm.
potentially, what should be the rebalance in that sort of scenario? Right? Because
Yeah,
they're
yeah.
not in the trade essentially, right?
Yeah, yeah. So that definitely becomes tricky because we are sending immediate or cancel orders, right? So if it doesn't get filled, then the order gets canceled. Typically, you could, on the small case app, I've observed that you can put a repair order that goes out next day in the morning. So if the stock sort of recovers from circuit, next day you would get that stock. Or you could sort of try out at different times in the day if you're watching the stock and the circuit has broken. See, sometimes we miss out on stocks hitting upper circuit. I don't feel that bad about it. See, it's a missed opportunity, but you could get that stock in the next few sessions. I think the bigger concern, if the stock starts hitting the lower circuit, I think that is when it causes the biggest worry. And typically, if that happens, we would come out and, sort of educate you with the strategy, work along with the small case team. If you remember, I don't know, I know there are a lot of investors of ours who actually have been with us for a very long time. I keep on meeting people who've been with us for 2, 3 years. And if you remember around 3 years ago, when there was some news in the Adani stocks and they were hitting lower circuits for a few days, we in fact worked with the small case team, got all our investors to exit it by placing GTC orders and then editing their small case portfolios. If a situation like that happens, which is the risk event, we can work with you. But circuits are part of the market. You cannot do much to control it, but obviously we're there to help you as it goes, right?
Sure, absolutely. We can take a few small case specific questions, and then I'll sort of jump into more broader topics. One question that we're sort of seeing a lot on, I just have one question from Arun, and I think recently I can see Srinivas also has asked a question, is on Titan and balanced. From a long-term view, what is better, the balanced multi-factor portfolio or the Titan portfolio, and ultimately which one is the one that you would sort of prefer going forward?
Yes. So again, these are distinct portfolios, right? Our Titan is very, very clearly large caps, right? You would only see stocks with 20,000 crores and up market cap in that portfolio, right? But balance is a flexi cap, right? So much like a flexi cap fund, it would shift between large, mid, and small cap. So right now it does have a bias towards large caps, but as when the small cap rallies really resurges, it would start allocating more to small caps also, right? So that changes, its allocation changes. So if you look at the broader scheme of things, obviously, see, small caps do better in the long term. They do it with a lot of risk, but they definitely do better in terms of returns in the long term. So if you're creating a flexi cap strategy, you could get a better long-term returns in comparison to only large caps, but then only large caps will give you stability. And Right Titan, while we keep on saying large cap, large cap, large cap, it's a very differentiated strategy in that universe also. So it's not like investing into the Nifty and expecting slow growth. It is actually, we expect it to do much better than the index because of the factors that we've selected. We've selected momentum, we've selected quality, we've selected low volatility, and this healthy mix of factors will give it a much better return in comparison to a large cap index, right? So if you look at some of the mature investors who've been into the market, you would see they keep a significant allocation to large caps, right, in their portfolios. And this is an excellent strategy to fit into that allocation because we expect it to definitely do better than the large cap index or the large cap funds, right? So Titan is an excellent strategy to allocate into the large cap universe, and balance is a flexi cap, so it would go to small and mid caps also. In the larger scheme of things, balance could give you better returns, but large caps, but Titan will give you that stability, right?
Got it. And just sort of with the Titan theme, there's another question here from an investor who's invested. Their name is Squid Bhai. They've invested in Alpha and Momentum. And what they're asking is, given that there's more volatility in the next year at least, should they make a switch from the Momentum or the Alpha portfolio for one of them to, let's say, a Balance or a Titan portfolio, given that there is probably a safer and a riskier sort of allocation then for them? It's a very healthy mix.
No, I think that definitely does make sense. I was talking to an investor yesterday who was telling me that, despite all the rebalances that we are sending, they end up applying stop losses and getting confused with the allocation. If that is a concern that sort of impacts you, see, I really believe into our alpha and momentum strategies, right?
Yeah.
We expect them to do excellently well in the long term, so there's no problem in investing into them. But if volatility is a concern, then you should have some allocation to Titan, right? Because that sort of balances your allocation. Yeah, so I think that would be my call here. That you should if you look at like I said, look at some of the mature investors, you would see they do put significant money into the large cap universe, right? And this is an excellent strategy to do that for you. But obviously, we believe in our momentum and alpha. We expect them to do excellently well in the long term. So, don't be worried about it, and don't try to time the market like we said.
Sure, sure. No, absolutely. Just moving on here, I'll move to sort of elections and maybe sectoral focus as well. So on the election front, we've got a question from Rajesh G. He's asking, how would election results affect our overall investments? I think we've sort of covered that through the discussion and the PPT that you've sort of shared. But any
Answer.
ideal strategy that you can sort of give to insulate portfolios against undesired election outcomes?
Think that's a question for which there is no real answer. What we sort of expect is definitely some volatility around that election day, depending on the outcome. If you look at the expectations from the market, we're all aware, you're seeing that rally start happening in the infrastructure PSUs again. So, the market is pricing in the same policies continue, but there could be shockers as well, right? The poll trends could change. So definitely, I would assume that in the election result time, you definitely need to hedge your bets. Maybe we don't see we I don't have a clear idea what happens with our strategies. Maybe we deallocate a little bit around those times. Maybe it would really depend on the scenario. But yeah, I think there could be volatility at least for a short span of time, but there would be a resurgence also, right? So what we saw that even despite any shocker or anything that happens, the market continues to be very strong pre and post election historically. And like I said, there are these strong cues in terms of growth, in terms of foreign investments, in terms of strong earnings that will support the market, right? So I think so I really don't believe that you should be tying up pure political views with the markets. I think these are distinct things, and that is the sort of wise thing to do, right?
No, absolutely. Makes sense. From a sector perspective, there's a question on metals and the sort of opportunity that was there in the last 1 month, along with sort of commodity linked stocks. Do you think that opportunity is still there, or do you think that opportunity has been missed?
See, I think that's a very tricky thing. Metals, go and look at the metal index. They are one of the most volatile sectors that is there, right? I remember once I was trying to create a strategy and trying to optimize it. I actually ended up removing metals from it. We don't remove it right now, but that is something that we've done sometime in the back. So metals end up being highly volatile. See, there is a resurgence in metal prices when people expect economies to be very strong, right? When there's going to be a lot of manufacturing, a lot of growth, we need metals, right? Right now with the EV theme resurging, there's a lot of need for metal in that industry, right? So those type of cues definitely lead to people talking about a commodity cycle, commodity upcycle, long-term growth in metals. But what is also something that I think right now is happening is there is a short-term demand happening from China, right? China historically in April, May month buys a lot of metal. There's a lot of activity. And that is what is causing this sort of price rise. If you actually look at the ratio, I think one very important indicator to look at is the ratio of copper by gold. I think that's a very strong economic indicator. And what you would see is that in fact hasn't picked up, right? So it could in fact be a short-term rally. And so I will not say that metals are going to be the flavor in the next 1 year. I don't think that we just have a clear indication for that. But obviously, there's a lot of opportunity in that segment. You have to watch out for, but be aware that it's a volatile segment, right?
No, absolutely, absolutely. And just to sort of add on from a sectoral perspective, there's a few questions that we're seeing both on the forum and the chat, which are revolving around what are your sort of, let's say, picks for the next short term to long term. So let's say the next couple of months to a 5 year window. What sectors do you think people should be sort of focusing on?
No, I think it's been very interesting, and that is the big question, right? See, I think definitely financials, if you just look at earnings, I think financials will take the pie there. Financials will post these good earnings. They will be the flavor. So that definitely is something that look at. If you're looking at volatility, then allocating to more FMCG, consumer durable, consumer discretionary, I think that will always be stable in any sort of market scenario. That makes sense. If you're looking at again, volatility, then pharma ends up being strong. Pharma is a strong thing that is playing, so that's an interesting sector. Slightly longer term outlook, IT could be a strong pick. And see, I will be very honest, I'm also looking at a lot of small caps right now. You've seen a rally in small caps, a pickup in small caps happen in the last 1 month, and we're seeing a lot of exciting opportunities. So a great healthy mix of stocks to be looked at. In terms of overall sector biases, I would say, there is manufacturing, infrastructure is still playing strong. You're seeing financials and pharma, some of the interesting plays, and metals are also coming very strong right now, but you have to see what is the direction there.
Got it. And more from a general perspective, there's a few questions regarding, so one is from Mr. DM. He's asking more from a rebalancing and let's say a risk management perspective. How would we adjust our portfolios, or how does Wright sort of adjust the portfolios if the market was to fall by let's say 10, 20, or 50%? Like what is the sort of deallocation strategy that we follow?
Right. So, when you see the dealloc, see, there are a couple of things, right? One is we are in fact trying to anticipate corrections, right? So we have something called a regime model, which is trying to forecast risk in the market. So we are trying to do some amount of timing at our end for sure. What that does is looks at the macroeconomic scenario, based on it, comes up with a analysis of the risk in the market, right? It says that is it going to be a risky market or a low risk or a high risk market? If it is a risky market, then we automatically start taking lower risk in the strategy. You will see a shift to safer stocks. But if you're seeing a bullish sort of trend, that we are, doing aggressive investing anyways. So to give you an example of 2020, right? February, if you remember February 2020, there was a lot of volatility that was already happening. So we were deallocated back in 2020 Feb only. Therefore, when the correction happened, it did not impact us that much. But having said that, we also have another layer of risk management, which is called deallocation. So if your portfolio corrects by 10% in a short span of time, then you would see us taking away 10% of the stocks from the portfolio, moving it to a liquid fund or a liquid ETF, right? Which we did, in fact, in March for a little while, right? So to have the deallocation policy now, with the 10% goes to 20%, then you would see 20% deallocation. If it goes further, then we would further increase the deallocation till the correction seems to be over and the stocks recover, which is when we start reallocating, right?
And he's also got another question asking about the reverse repurchase RRP fall on the Indian stock market. Any idea or thought on that?
I am not aware of that. What does this mean?
I was also not sure, so I was hoping maybe he would know. I'll sort of research and let you know about it as well. There's another question here where Mr. Pankaj is asking, he wants to sort of learn when to buy or when to sell at any point. So is there some way that he can learn it, so to speak, in terms of market timing?
No, I think, see, like we said, simple things like with buying at a 5% correction, 10% correction, we showed you an analysis. It does enhance your returns a little bit, but might not give you a lot of opportunities to invest. Very tricky in that sense. See, a better idea would be, how to time a particular stock would be to understand its outlook, right? Understand its technicals, right? What are the charts telling you? What is the outlook telling you? You could time it based on that, but there are broader market direction at play which would come and play spoil sport. So typically, that is how people typically try to time entries and exits in a particular stock. But what I would really say is short-term panic, selling at a 10% correction or selling at a 5% correction, and trying to do that does not work really well. I think what you have to do is stay invested, and if you are actually investing into the strategies that we are talking about, these are long-term strategies, right? So see, when we do momentum, I'm trying to capture bigger trends, right? I'm not trying to capture a 5-day movement, right? So when you're trying to capture bigger trends, then you have to be there in the market for the longer term, right? So putting, small stop losses, exiting at any small Q does not make sense. Have a holistic approach. Look at multiple factors about the particular stock. If they're giving you a clear indication to enter and exit, that's how you should take that call.
Got it. Got it. Just so maybe this might be a very good question for you. I'm not sure. So there's a few questions that we've got on the chat where people have asked Mr. Venkat, Kurva, Priyank. They're all asking, one, what is the best small case for long term, and second, what is your favorite small case in right?
So best small case for long term. I am invested in all of my small cases. I posted a screenshot of that on Twitter also. I, in fact, have invested in each and every small case that we have to offer. Best small case for long term. See, the answer is it has to be a function of your risk profile, right? And it is, everybody has a different risk profile. I'll be very honest. I talk to so many investors, and some of them actually, they understand, okay, alpha could correct a lot, but I want that high risk exposure. So for them, that makes sense. Some of them definitely want momentum, but slightly balanced. So they go with momentum. Others who are looking at a much more balanced approach, then, by name, balance is the better one for them. If you're looking at large cap exposure, then large cap Titan makes sense. So you can, it is a function of your risk profile, and your short term and long term goals. If you want to invest at least for a year or so, only then invest into a strategy. I'll repeat that again and again, that have a slightly longer term outlook. Don't try to make big money in 2 months with our strategies. That could work. That could work for you in some instances, but in other instances, it will not work for you, right? The markets are unpredictable. I am not telling you I will be able to predict the next couple of months, but I will be very much more assured in telling you that these strategies could do well in the long term, right? So, have a longer term outlook, and, one of the other strategies, like I said, would fit into your risk profile, or a combination of them will in fact give you a better allocation. In terms of my favorite strategy, I think I like all of the strategies. There's no favorite. I love all of the portfolio that we have to offer, and all of them are very unique, right? So from momentum, alpha, balance, titans we talked about, to new India, right, which has given a very strong return, to innovation, which is a unique portfolio. I think all of them are very interesting.
Great. Yeah. So there's one question that we've got, which is slightly interesting. Maybe we've not had it before. It's about having a monthly SIP for, let's say, a momentum or a alpha prime portfolio. Some of these that are very strong bull run stocks or strategies that we sort of have on our site. In that case, does a monthly SIP really make sense, given that um, they'll do much better in bull runs and not so well during, let's say, when the market is sort of moving sideways? So any thoughts on that?
See, I think, again, you have to think about it. It's a basic math. If the market is continuing to fall and you come up at the top, then you will book some losses. If you come in at a bottom, then you would get that flavor of the rally, right? So SIP definitely will give you certain opportunities that will be at the most appropriate time, at the times of corrections you will end up buying, and you would get that the benefit when the rally happens. On the other hand, you could get sometimes you could come in at a bad time. So, but on an average, I think SIP is a much more easy way to allocate, right? Instead of trying to time with each correction, I think SIP would make more sense. But if you have a slightly more uh, involved sort of, you're looking at the market in a much more involved way, then maybe entering at a 5% correction or something like that could be something that you do, or maybe looking at stability from the market when you think that market has stabilized, and then topping up would make much more sense. So, you could do that, but I think SIP is the easiest way to allocate, right?
Got it. And there's one question from a booking of profits and sort of reinvesting them perspective. This is Mr. Anwar Laksh. He's asking, does it make sense to book profits and reinvest them when, let's say, for him the benchmark is the long-term Nifty CAGR of around 13%, after including, let's say, any short-term, long-term capital gains and exit loans. And then how would you sort of think about that?
No, so booking profit and reinvesting, see, you could in fact sort of miss the boat if you're trying to do that. Again, I'll talk about somebody I was talking to yesterday. They entered at the bottom of the 2020 crash, right? And then they sold everything at 10,000 of the Nifty. So they entered at 7,000. They sold everything when the Nifty went to 10,000. They thought, yeah, everything, it won't go up. And they were trying to time the market. They missed that amazing rally, right? And the market went from 10,000 to now close to 22,000, right? So again, you could do that if you could perfectly predict the market. If you know that there's going to be a correction and I'll re-enter after some time, that could be, if you could predict that, then you should do that. But I'll tell you from my experience that, even I can't do that well, right? That, tell you today it's a correction and, tomorrow or after a week or after a month, there would be the rally that could happen. So I think that's very difficult to do. So, so I think that's the answer. So it's extremely difficult to do that, right?
Got it. Got it. There's one question which I think he's asked it earlier also. I'll just quickly take it up. He's saying that he's been an investor since around January of this year. He's applied all the rebalancing calls, etc., on Alpha Prime, but his returns are showing what the returns are showing is around -4 compared to where the Alpha Prime is showing a growth of about 10%. So he's wondering why that deviation might be there.
So if you have rebalanced exactly on the same dates, then this deviation is quite a lot, right? So you could send us the portfolio, we could have a look at it, but typically we don't expect this much deviation. We do expect 1 or 2%, right, depending on how you entered and some costs, but it shouldn't be this much. So we could definitely have a look at it if you share that allocation.
Sure, I'll just drop him the details on chat. Cool. I think we've covered most of the questions. I'll just quickly go through the chat just to see if there's something we've not. Mr. Muralidhar, he had, I think, met us in one of the Bangalore meetups that we've done recently, and made a suggestion there as well. Can we implement some sort of a nudge indicator to average whenever such situations like corrections or volatility occur, for our small case portfolios?
No, I think, see, you can see that is on our mind, right? That's why we've done this whole session on what is the right time to top up and when to top up. And I was talking to the small case team also. They might give us a feature to give you that nudge also. So, we are sort of planning that. And when we think that it's the right time to jump back in, we will give you a nudge, right?
Sure. Mr. Srinivas, you can reach us at info@wrightresearch.in and we will sort of respond back to you there. I think we've covered a lot of the questions. So, I will just quickly go through a few more. There are a few PMS related questions. I think we'll reserve that for a later time. There is one interesting question where Mr. Subha had asked the fact that there might be a lot of movement or capital flow happening into large caps in the market, from not just from small case investors, but let's say from other PMS funds, larger FIs, etc. Do you think that'll have an impact on how, let's say, Titan performs, or how the overall strategies that we currently have, which are focused on large cap or have allocation to large cap, will be sort of impacted?
Right. So large caps have massive amount of liquidity, right? So I'll tell you, we were trying to trade in TCS, right? When you're doing a trade in a small cap stock and you have to trade a lot of shares, then you have to be very careful. So we look at what is the average daily volume in terms of the share, if we can in fact participate, what is the time for which we have to slice and all that. For large caps, you can in fact, there's so much liquidity. Look at the volumes on TCS or Reliance or Infosys, it's massive, right? So, any flow from small cases or any of the PMSs are not going to actually move the needle there. larger flows, if that they happen, then they could move those stocks. But essentially, what they bring on is a lot of stability and a lot of, benefits of that liquidity. So, you don't actually have to be concerned about liquidity in large caps. Liquidity is a problem only when you are, allocating to the smaller stocks.
Right. And again, so from a Titan perspective, one of the questions user just asked is, a few of these stocks have very high PE, with not very high sales growth. Do you see good prospects for such stocks also in the future, given that they're in the Titan portfolio right now?
No, I think, see, like I said, we do not just pick these stocks based on their returns. We have looked at the risk metrics, we have looked at the quality metrics, and we've taken a tactical call. We do expect them to be strong. There could be certain stocks that have high P ratio, but high P always does not mean that, there's going to be a cut in valuation. Sometimes there is so much strong expectation that the P gets inflated and the stock still performs well. But, we'll be rebalancing it as per, the strategy and move around within the strategy. But, we're not extremely concerned on the valuations right now.
Got it. Cool. I think with that, we have sort of reached the limit, Sonam. I think we can probably wrap up.
Yes, yes. Thanks a lot, guys, for coming and, listening to us on the Sunday. Always a great time coming on the Small Case channel. And I hope you guys had a good time. And like we said, uh, don't try to time the market, be in the market and always have a long-term vision. We'll see you soon on the Small Case channel. Do go and visit us, our channel, and look at what we'll be posting there. Have a great Sunday and we'll see you soon.
Thank you.